know, India is one of the world's great growth engines, an absolute economic powerhouse. But, underneath that incredible story, there's a quiet crisis brewing in the insurance world. And it's one that could act as a hidden brake on the entire economy. So, what is going on here? Let's dig into the forces that are totally reshaping risk in one of the most dynamic economies on the planet.
Okay, start with this number because it's just staggering. According to Swiss Re, over 90% of the economic losses from climate-related disasters in India are completely uninsured. Think about that. It means when a disaster hits, the financial hit falls almost entirely on regular people, on businesses, and on the government.
And that brings us to the really critical question. What about that tiny slice? That little 10% that is covered? Well, it's now facing immense pressure. So what happens when the global giants who backstop all this risk just decide it's not a gamble worth taking anymore? And this isn't some far-off hypothetical. It's a shift that is happening right now.
To really understand what's happening in India, we've got to zoom out and look at the global picture first, because this isn't about insurers singling out one country. Nope. This is about a fundamental worldwide change in the business of risk.
So there's this term flying around in the industry called the three-digit club. And what it means is that since 2020, every single year, global insurers have paid out over $100 billion for natural disasters. This isn't a fluke. It's not a one-off bad year. It is the new, brutally expensive normal. And it's putting a massive strain on the world's biggest reinsurers. The companies that insure the insurance companies, like Munich Re and Swiss Re.
So, faced with these huge, consistent losses, what's the logical business response? Well, reinsurers are cutting back their capacity. That's just industry speak for the amount of money they're willing to put on the line. They're pulling their capital away from regions where climate events are getting harder and harder to predict, which, of course, brings us right back to India. So how does this global squeeze actually play out on the ground in India? This is where the problem hits a very specific, local challenge. The core issue is that India's climate future is becoming incredibly difficult to read. And for an insurer, what you can't read, you definitely can't price. The entire business of insurance has always worked by looking back at decades of data to predict what's next. But that whole model, it's broken. The past just doesn't predict the future anymore. And it's not just a feeling. A recent MSCI report found that a massive 91% of insurers believe these historical models are losing their reliability. Past monsoon patterns just don't tell you anything about a 21st century cloudburst.
And this brings us to the real game changer, a key term called secondary perils. See, insurers are pretty good at modeling the big primary events, like a major cyclone hitting the coast. What they can't model are these secondary perils. A sudden flash flood in Mumbai, a localized cloudburst over a factory in Gujarat, or a brutal heat wave that shuts down supply chains. These are the events now causing billions in damages, precisely because they're so hard to predict.
And this map from Swiss Re really shows where this problem comes to a head. India's most important economic zones, its industrial clusters, its special economic zones, its major ports, are heavily concentrated in coastal states like Gujarat, Maharashtra, and Tamil Nadu. We're talking trillions of dollars in assets in cities like Mumbai and Chennai, sitting directly in the path of these increasingly unpredictable floods and storms. It's a recipe for major systemic shocks. So all this growing, unpredictable risk, it creates an unavoidable financial conflict. It's really a standoff between the price that insurers have to charge to stay afloat and the price that the Indian market can actually afford to pay. And to put a number on that, get this. Sources suggest that for insurers to price these natural catastrophe risks accurately with today's climate models, premiums would need to jump by 300%, or maybe even more. That kind of price hike, it's just not viable for most businesses. And right here, you can see the two opposing forces at play. On one side, you've got global insurers. They have to price risk based on what their future climate models are telling them just to stay in business. But on the other side, you have Indian regulators. Their job is to protect consumers and keep insurance affordable for everyone. When those two goals are in direct opposition, well, something's got to give. And what's giving is the very nature of insurance itself. But this isn't some loud, public, we're leaving kind of exit. No, it's a quiet, calculated retreat, a strategic shift in what kind of coverage is even being offered in the first place. So instead of traditional insurance, many of these global players are now pivoting to something called parametric insurance. It's a completely different model. It doesn't pay for your actual damage. Instead, it pays out a fixed, pre-agreed amount of money if a specific trigger is met, like, say, if rainfall in your district goes over 200 millimeters in 24 hours. So what's the trade-off here? Well, traditional insurance, it aims to make you whole again, but we all know the claims process can be slow and complicated. Parametric insurance is the opposite. It's incredibly fast. The payout is objective, it's automatic. But, and this is a really big but, that payout might not cover all of your losses. This creates what the industry calls a protection gap. That's the difference between the total financial loss and what the insurance actually covers. And it's a gap that businesses are now being forced to fill themselves. So this new reality, right? Limited coverage, growing risk, it means India can't just rely on the old model. The question now is, how does the country build its own financial resilience and start to bridge this really dangerous protection gap? Well, the path forward is probably going to be a mix of things. Instead of relying on these failing global models, India could develop its own highly localized risk models using AI and machine learning. Instead of depending on foreign capital, it could create its own sovereign risk pools, where the government itself steps in as an insurer of last resort. And of course, it's going to demand really strong public-private partnerships to fuel investment in climate tech and build more resilient infrastructure from the ground up. Ultimately, as the Observer Research Foundation puts it so well, this challenge really demands a totally new way of thinking. This isn't just an insurance problem anymore. It's a test of macro-financial stability, and it's a huge catalyst for innovation. The retreat of global capital isn't the end of the story, but you know what? It may just be the urgent call to action India needs to write its own. We all